I'm brought to you by the Cannabis Lab. This is our last interview here live from the Benzinga Cannabis Capital Conference. And the only thing I'm happy about is the fact that I can cut out saying those three C words together. But it has been an amazing time. The folks at Benzinga put on a phenomenal show. Year after year, it gets better. This podcast is a special home here. We did episodes like 4 through 7 here. We did probably another 8 last year. I think we're up at like 15 or 16 this year. And I hope they continue to give us a home here. They keep upgrading our facilities, and the guests that we get even better every year. So this is a company I've been familiar with for a while now. I got into the industry around 2018, 2019. You guys had already been in the industry for a little bit. So please welcome Travis Goad, the managing partner of Pelorus Equity Group. Travis, thanks for joining.
Hey, Todd, thank you for having me.
Absolutely. So I've seen you guys around for a long time, mainly because you've been funding the industry for a long time. Definitely one of the mainstays in the industry. How are things going for you guys lately? I imagine there are less significant companies for you guys to find these days than early on.
Well, we're actually seeing a lot of opportunity, and just for, I guess, the listeners who may not know, we're the longest running cannabis lender in the sector. We closed our first loan in 2016, and we've done a little over 540 million since inception of originations. And so we are still seeing opportunities. It is a challenging time in a lot of markets in cannabis, specifically. We view it as more of a natural growth cycle where we're on a lonward upward trajectory, and there's some short-term volatility around that, where markets go through periods of oversupply and then prices kind of go down, and then there's some of the weaker guys don't quite make it, and then the people that do stick around, and there's usually a pretty big bounce back. And so what you saw most of last year was an oversupply in California, an oversupply in Michigan, and what we're seeing kind of year to date is that pricing has ticked back up as some of that supply has come forward. So we are still seeing opportunities. We're still seeing certain very strong operators, and there's certain brands that are really starting to emerge and take market share in a way that brands haven't traditionally in the past. So yeah, it's interesting.
Let me ask you an interesting question there in regard to brands, because brands is somewhere where I'm very fond of, and I've worked in that space before. How are you guys able to work with brands? Because as I understand the way that the lender there's got to be some kind of collateral. And from what I see, there's a lot of brands that are not chasing, but they have this asset light model. And realistically, the only thing that they own that's tangible at all is their IP. A lot of them don't have cultivation facilities. They don't have retail. They don't own equipment. You know, a lot of them is just their IP, and they're marketing their brand. How do you work with those types of
what that model you described as the asset light, that wouldn't fit our lending model. You have to own your real estate to qualify for our lending program. But there are a lot of brands out there that do own their own real estate. And so if that's the case, I mean, what we see is a kind of maturation of what's happening is that used to, I would say even 2-3 years ago, everybody had slick packaging. Everybody had something that looked like a brand, but no consumer really resonated with that. And so the consumer is indifferent. What you're starting to see is certain brands emerge that people are coming back to and buying, and they associate it with the quality, or they associate it with the value. And you're starting to see kind of market share edge over to that, where I think brands are finally, after multiple years, starting to get some traction. And so we're excited to see that. And what we've seen is most of these operators that are weathering the storm better than others are during these periods of oversupply, are ones that can control their own shelf space and have a brand that people want. And you're not selling just bulk wholesale flower. You're selling branded product and maintaining margins.
Very cool, man. So I love the fact that you guys are still, because right now it's no secret that the capital inflow in the industry is dripping compared to where it was, 2 years ago. And certainly last year was very hard for a lot of brands, which is good and bad for the industry. A lot of good people are losing jobs that they went out and took a limb for, but companies are getting leaner, and hopefully the ones that do well will make it out the other side and be stronger. As somebody who focuses on the industry, you can see that firsthand. But right now, especially from an investment standpoint, cannabis it's got really, we're trying to do a show here. It's like the Gong Show here. So cannabis, you can see how easily distracted I am. So, cannabis has this like bad taste in people's mouths, because to me, what people, the serious investors, they look at the public markets and then look at the public equities, and those are not doing well. A lot of the ETFs are down significantly right now. If you talk to the average investor, they might have gotten burned on one of these big MSOs. I imagine the deployment of capital, that's business as usual. You do your due diligence, you look at the collateral, and you figure out, is this a good deal or bad? When you guys are out there trying to find investors and raising capital, how have those conversations been going, where it's like, hey, listen, look, we've been doing this for a long time. We can clearly find the better companies. Is it harder to find the people that are still willing to allocate to cannabis?
So I think in the broader macro markets have shifted as treasury rates have gone up. Now there's additional opportunities for investors to put capital away from just non-cannabis equities as well. So we're in a unique macro environment, but we're still finding investors, and investors are ultimately attracted to strong returns. And so we've done between 12 and 15%.
Very attracted to strong returns.
Correct. So we've done 12 to 15% every year since full operation. And what we think is the better way to get exposure to this space is via debt, if you're an investor. So if you come into our fund, we're a first lien lender on the hard asset of commercial real estate. And so we're a little more insulated from individual operator risk. We want all of our borrowers to thrive and do great. And that's really what we're trying to facilitate. But if there was a situation where one of our borrowers was underperforming or failed to make their business work, if you take just the real estate as collateral and you're judicious in how you size your loan, a new operator who would be more efficient and would be able to operate profitably out of this location would like it. And that's what we're actually seeing a lot of is to grow quality cannabis, you need this very specialized infrastructure of indoor grows and specialized greenhouses. And that didn't exist in the US. And so as the first stage of growth, everybody had to build it. And then right now, what we're seeing is when it was super easy to make money, people never paid attention to the OpEx line item. Yeah. You could be profitable or cover your OpEx expense very easily. Now what we're seeing is when the industry matures, you actually have to compete. And there's actually real cost savings that people are having to look at. And the ones that we're seeing that are outperforming in our book and kind of in the broader industry are the people that have figured out expense savings quicker. And that's not just on labor, that's on all sorts of other things, mechanization. How do you just be more lean and mean as you're doing that? And we think that's going to be kind of the next level of growth in this space.
So what are you seeing as the profile of the companies that are successful that you're seeing? Is it a lot of these, that were very good single state operators that figured out that state and then leveraged the income they had in that state to move into another state? And maybe at that point, that's where they're like, hey, we have these assets. Let's get a loan to go into another state. Are those the type of profiles you're seeing, that the people that, started small and just kind of grew at a nice pace instead of, and I think the failure of this industry, or a lot of people, what they did in this industry is they took the tech approach where it was market share, market share. We'll worry about profitability later. Well, it's when you're an application and you can make money off advertising, or it's just, snapping your fingers to spin up another license for that application. It's very easy to get market share because you don't have to put hard costs into that. You don't have to buy a building. You don't have to put out product from that. Cannabis is CPG and it's agriculture, and you can't really just go market share. It's very capital intensive. So what are you seeing as far as the attributes of some of these companies that are seeing success?
So I agree with other things. Some of it is a single state operator that's done well, and whether they're single state or multi-state, what we've really seen is, again, the wholesale model used to be fine. You grew it, you sold it, and somebody else put it under their packaging. What we're seeing in these markets when they get saturated, the wholesale only model is the one that's hurt the most. Mm-hmm. And those are the guys that are feeling the pain because it's a non-differentiated product, and they have to take whatever price the market will bear. And what we're seeing is whether you're single state or multi-state, if you have a brand, and this gets back to the brands becoming more important, if you have a brand, you have some shelf space, you're able to cushion those margins and still sell through at a higher retail consumer price. And so that's one of the things we've noticed. And the other thing that we've noticed about people that are doing well, they're really focusing on the expense line item. And so, we look at people in our book, we look at other public operators, et cetera, and try to figure out, what are your costs? Why is it costing you to produce more here than there? And what are the ways you can look to save? And so what we've seen actually is in some of these unlimited license states where, certain other lenders, people that have, tried to compete with us in the market say, oh, we don't want to go. That's a hyper competitive unlimited license state. Those are the guys figuring out how to be profitable or to operate EBITDA positive in a very challenging environment. And they're doing it both on a mix of a good product, a quality product, a brand, and then they're doing it by savings and right sizing operations. And so we've just noticed they made the change quicker, and we think the rest of the industry is going to follow suit.
Very cool. It's really interesting, man, and I'm very bullish on the future of this industry still, and but I think it's going to be a tough year for operators. You know, I think we've talked about this year of M&A for so long, and it's always had such a positive spin on it, where people were going to be able to exit and they were going to go through acquisition and everything else, and now it's kind of on the other end of it, where it's M&A to survive.
Yeah.
And it's going to be an interesting year. So on that note, you know, what do you see happening the rest of the year in the future of this industry? What are some of the trends or some of the assumptions that you're making?
Yeah, so I think the rest of the year it is challenging for you. You need to, like I said, get efficient. You need to find your space in the market and deliver quality product, and I think you'll make it. But if you're having issues, there are going to be a lot of these. I think some consolidation to survive. I do think that some of that's going to happen. So from a real estate perspective, we're okay with the consolidation as long as the facilities still have demand. So I think you'll see some consolidation. I do think you'll see, people figuring out the efficiencies and actually starting to drive EBITDA growth, et cetera, in the space. But long term, very bullish. I mean, if you look at the sales nationally, it's about $27 billion a year in sales. Projects to go to 45 billion with a mix of new states coming along and growth. But if you look at the consumption, it's going up. Like each year it's changing to where it's no longer your daily consumer only. It is it's soccer moms, it's other people. And so one of the stats I look at in most of these legal markets is about 17% of the adult eligible population consumes once a month. If you compare that to alcohol, it's about 55%.
Yeah.
And if you compare it to alcohol once a year, it's almost 95% of the population. So I think as it becomes less stigmatized, more products come out that are maybe not just smoking a joint, it's an edible, it's a beverage, it's some of these other form factors that more people are going to uptake it and kind of either complement it with alcohol or substitute it for alcohol. And you'll get market share growth just from that, even without new states coming online. So I think we're definitely bullish on the industry. And this industry is going through changes and evolving as we speak. And again, we think it's going to come out stronger on the other side and maybe a little bit more consolidated. But people want the product.
They do. Well, I'm excited to see what happens, Travis. I appreciate you sitting down with us, man.
Thank you. Thank you for having me on.
Where can people find you if they want to work with you guys?
Go to Pelorus equitygroup.com. Go to our website, and there's information there. Whether you want to be an investor, there's an investor relations that you can reach out to, or if you're interested in borrowing money, you can come and reach out and contact.